Hi everyone, this is Knowledge Topper, and in this video we will discuss about another most important liquidity ratio, and that is quick ratio, or you can say acid test ratio. We are basically covering the series of financial ratios, so this is one of the videos of our financial ratio series. We will understand this with the help of an example, as always we do. So more importantly, your concept should be clear. You can watch all of the financial ratios videos by clicking the link in the description of this video. So first of all, we will look at what quick ratio is, or what acid test ratio is. We will discuss this in general first, then we will further discuss more about quick or acid test ratio in detail, and at the end we will solve an example as well, so your concept should be clear more importantly. But before moving towards the main, if you didn't subscribe to our channel Knowledge Topper yet, please do subscribe to our channel Knowledge Topper, as well as like our Facebook page, and do join our Facebook group as well, where you find a lot of good material related to these topics as well as from other courses as well. So as written on your screen, the quick ratio or acid test ratio is a liquidity ratio that measures the ability of a company to pay its current liabilities when they come due with only quick assets. Okay. If we talk about quick assets, these are current assets that can be converted into cash within 90 days or in the short term period of time. If we talk about the examples of quick assets, like we have cash and cash equivalents, short-term investments, marketable securities, and current account receivables. So these all are considered as quick assets. Okay. Though inventory and prepaid assets are also part of current assets, but we are mainly talking about quick ratio. We are only considered quick assets. Okay. So if we talk about inventory and prepaid assets, they are not basically part of quick assets because they are not easily converted into cash, in terms of liquidity we are talking about. Like all other current assets like cash and cash equivalents, short-term investments, marketable securities, and current account receivables. So these all are considered as quick assets because they can be converted into cash within 90 days or in the short-term period of time. Okay. Generally, if we talk about short-term investments or marketable securities, it includes like trading securities, and they are basically available for sale securities that can easily be converted into cash within the next 90 days. Okay, so one more important thing related to the background of this ratio is that quick ratio is also called acid test ratio, as I already discussed with you guys. Because early miners way back many years ago used acid to test metals for gold. Okay, if the metal passed the acid test, it was considered as pure gold, and if metal failed the acid test, it was considered as base metal that has no such value. Okay, and when we talk about the acid test of finance, if we talk about this ratio, basically it shows how well a company can quickly convert its assets into cash in order to pay off its current liabilities. It also shows the level of quick assets to current liabilities. Now, if we talk about the formula, I will show you the formula. The quick ratio is calculated by adding cash and cash equivalents, short-term investments, current receivables together, then dividing them by current liabilities. Okay. But as part of studies and examination and project of students, sometimes companies' financial statement don't give a breakdown of quick assets on the balance sheet. So in that case, you can still calculate the quick ratio, even if some of the quick assets totals are unknown. Now, how can you do it? By just simply subtract inventory. As you can see, we have total current assets, and you have to subtract inventory and prepaid expenses from that, and then divide it by current liabilities. So you can also apply this way as well. We will do an example now, so it will be more clear to all of you. So now quickly move to our example that I prepare for you guys. Okay. So here's an example. Let's assume Knowledge Topper's clothing store is applying for a loan to remodel the storefront. the bank asks Knowledge Topper for a detailed balance sheet so it can compute the quick ratio. Knowledge Topper's balance sheet included the following accounts. We have cash of $10,000, inventory of $5,000, accounts receivable of $5,000, stock investments of $1,000, prepaid taxes of $500, current liabilities is $15,000. So what we have to do is just extract and take out the important figures from the balance sheet and just put it into your formula. So we have cash as $10,000, so we simply take out the cash amount of cash, 10,000, so you take 10,000 cash amount here, and then we have 5,000 of accounts receivable, like here 5,000 of accounts receivable. Then we have 1,000 of stock investments. Okay, so we take 1,000 of stock investments, and we have current liabilities of $50,000, so we take $50,000. So we just add these values, and if we divide it by $15,000, we will left with 1.07. Okay, here as you notice, we will not take inventory because as I already told you, inventory and prepaid taxes, like these are prepaid assets, so we will not take both of them because these are not part of quick assets, so we will not take these, as I already discussed with you guys. Okay, so we just simply take out these figures and just calculate our quick ratio, so we will left with 1.07. so as you can see, Knowledge Topper's quick ratio is 1.07. This means that Knowledge Topper can pay off all of his current liabilities with its quick assets and still have some quick assets left over. Now let's assume the same scenario. Suppose Knowledge Topper did not provide the bank with a detailed balance sheet information like this. So instead, Knowledge Topper's balance sheet only included these accounts, as you can see here. So now we have now let's assume the same scenario here. So what we have to do, we have inventory of $5,000, prepaid taxes of $500, total current assets of $21,500, and we have current liabilities of $15,000. Since, as you can see, Knowledge Topper's balance sheet doesn't include the breakdown of quick assets, the bank can compute the quick ratio like this. So now as you can see, they just take out the value of total current assets, like here 21,500, and as I already told you, inventory and prepaid assets like prepaid taxes is not part of quick ratio, so we will just exclude these amounts, we will subtract these amounts from total current assets. So we have total current assets of $21,500, and we have inventory of $5,000, and we also have prepaid taxes of $500. So we will just subtract these and divide it by $15,000, so we will left with 1.07 again. Basically all these values are same that we previously solved the question. If I show you, as you can see right here, we have $10,000 of cash and we have $5,000 of accounts receivable. So if we add 10,000 with 5,000, we will left with 15,000, and we have a stock investment of $1,000. So we have if we add the $15,000, if we add the $1,000 in $15,000, so we will left with $16,000. Okay, and then if we divide by 15,000, we will left with 1.07. And if we total out these values, like 10,000 and 5,000, we got 15,000, and then we have 5,000 of accounts receivable as well, so it is 20,000, and then we have 1,000 more, so 21,000, and then we have 500 of prepaid taxes, so we have 21,500. So these all are basically our current assets. So now as you can see here, in this we have 21,500 of total current assets, and what we have to do is basically just subtract inventory and prepaid assets, like we have prepaid taxes here as part of prepaid assets, so we will just subtract these from our total current assets and just divide it by current liabilities, so we got the same answer. Okay, This is just the way if balance sheet doesn't include the breakdown of quick assets, so you can compute the quick ratio like this. Okay, so now while concluding this, I would just say that the asset test ratio measures the liquidity of a company by mainly showing its ability to pay off its current liabilities with its quick assets. Like if a firm has enough quick assets to cover its total current liabilities, then we can say that the firm will be able to pay off its obligation without having to sell off any long-term or capital assets. Like mainly most businesses use their long-term assets to generate revenues, and obviously like selling of these capital assets will not only hurt the company, like it would also show investors that the current operations of a company aren't making enough profits to pay off its current liabilities. Basically, higher quick ratios are more favorable for companies because it shows there are more quick assets than current liabilities. Okay, like suppose that if a company with a quick ratio of 1, it indicates that quick assets equals to current assets. This also shows that the company could pay off its current liabilities without selling any long-term assets. And an asset ratio of 2, like it shows that the company has twice as many quick assets than its current liabilities. So yeah, obviously like as the ratio increases, so does the liquidity of the company. Like more assets will be easily converted into cash if it need be. Like this is basically a good sign for investors, but it is an even better sign to creditors, because like creditors want to know they will be paid back on time or not. So a good quick ratio always does this job for the company. So this is the video for all of you guys. Hope you understand clearly about quick ratio or asset test ratio. If you like this video, thumbs up. Do subscribe to our channel Knowledge Shopper, as well as like our Facebook page, and do join our Facebook group as well, where you find a lot of good material related to these topics as well as from other courses as well. So this is the video for all of you guys. Thank you so much everyone. It's time to say bye bye.